Welcome back, everybody. So as you can probably tell, this is going to be a very, very, very different video compared to normal. Obviously, it's a completely different setup, right, to what we are normally used to. I am currently in Bangkok. We've got a lot of meetings going on. I'm going to an investors conference, so there's a lot of interesting things going on I'm quite excited about. But anyway, I just thought I would kind of jump on and kind of share my insights in terms of how I'm thinking about markets, and also kind of share some comparisons from the 1920s to what is happening today. So first of all, I'm not trying to predict the Great Depression. Before anybody starts to comment on that, I just want to highlight some things what I think are quite interesting. Also as well, this is not necessarily a history lesson on the 1920s. I mean, there's many other videos where you can kind of search and research on that. But anyway, I just wanted to kind of highlight a few things what I find interesting. So in the 1920s, we saw the US, what was one of the largest global superpowers, pretty much knocking around at the time. And as a result, they had a large export surplus. So they could obviously export the US dollar and obviously export deflation onto a lot of other nations. Now, when you are, let's say, doing a lot of exports, you were settling, the final settlement layer at the time was the gold standard. So as obviously your exports started to significantly increase, a lot of gold started to flow to your country, right? So the currency started to appreciate significantly, and obviously as a result, your exports are not necessarily as attractive to other nations. So obviously everything started to balance out. But obviously during that time, the US started to hoard a lot of gold, and what ultimately kind of broke the entire system. I mean, obviously we went into the Great Depression, blah, 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 blah. Again, I am not going to get into the ins and outs of all of that, but I just want to highlight that. Now, fast forward 100 years, we kind of see similar types of dynamics currently playing out, where China is the global superpower in terms of manufacturing and exporting. Now, over the last, let's say, 5 to 10 years, we have seen China be a very dominant player in terms of purchasing raw minerals and investing in developing countries in terms of getting access to these very rare minerals, and obviously what helps them to kind of, let's say, do more manufacturing, etc., etc., etc. Now, also what is, well, also very, very interesting to actually look at is that China was the largest buyer of US treasuries. Now, when you have a very large buyer of US treasuries, what typically happens is that the cost of these treasuries go up and the yields come down. Now, when you have a lot of selling pressure, you typically see obviously the price of treasuries come down and obviously the yields go up. So you kind of have this dynamic, especially when it comes to the bond market. Now, to kind of give you some more context, a lot of people are probably going to disagree with what I'm about to say, but I really do believe that the 10-year yields will probably start to increase. Now, this is a very contrarian viewpoint that many people actually have, because a lot of people, especially a lot of younger people, they really do believe that the Federal Reserve and the central banks can bring down the rates of, obviously, the cost of capital, right? But typically, the central banks have control over the short end of the yield curve. So to give you some more context, the short end of the yield curve is basically the lending of money on short duration. So this is typically between 3 months to 1 year or 6 months or whatever. And then obviously the long end of the yield curve is more like 10 years, 20 years, 30 years, etc., etc. And as investors, you typically expect that if you lend money for longer periods of time, you should be rewarded as a result. So if you lend money at, obviously, on a shorter duration, you typically don't expect that you are going to receive as much money on the shorter duration as you do on the longer duration. And typically when this dynamic is inverted, it typically indicates that we are going to be heading towards a recession, or a lot of investors kind of have poor sentiments and they're not really, let's say, that bullish about the economy, etc., etc., etc. Now, again, this whole video is not going to be talking about the yield curve inversion or, you mean, obviously the dynamics in the bond market, but that is the executive summary. Now, obviously, over the last year to 2 years, things have been getting a little bit tasty between the US and China. And as a result, I don't think personally China feels that confident in the US dollar. So they have been selling down their treasury reserve, obviously of US treasuries. Now, I think that this will start to continue more. And obviously, as a result, this is why I think that the 10-year note is going to go up in, I think the cost of borrowing is going to be incredibly expensive because China is offloading all of these US treasuries. Now, who is going to be a buyer of the US treasuries? I mean, that's obviously up for debate. Now, obviously, if you have a lot of intervention from central banks or et cetera, I mean, even that in itself is very inflationary. And, we're back in this whole, let's say, circus of, printing money, contracting, et cetera. So I kind of see it that, so just finish that point. I know I'm probably talking a little bit too quick, or I'm kind of, I don't know if I'm rushing because I've got a few meetings. I've had so many different types of matcha as well, so my brain is kind of firing on all different cylinders. But currently, China is buying a significant amount of gold. Now, this is also very interesting to actually look at because why would they be doing that? Are they kind of preparing for a post-dollar world where everybody kind of goes back to hard assets, such as, again, raw minerals? China's in a very good position for that. I mean, obviously, the US has a lot of natural resources going for it, but what I'm kind of getting at is that there's a lot of these obviously dynamics at play, right? And obviously we're seeing a lot of things happen with trade tariffs, and obviously China coming away from the US dollar can be very detrimental to the US economy, especially for consumers and also businesses. So also as well, I just want to touch on this because I've received a lot of comments about this, and that is trade tariffs and the impact of trade tariffs on, let's say, the US consumer, just the global economy in general. Now, what I think some people don't really understand is that China comes from a very powerful standpoint, and so does the US, obviously. But the thing is, if Trump obviously puts a 25% or 50% tariff on Chinese goods and enforces that everything is manufactured in the US, first of all, that is going to be incredibly inflationary for, again, many people in the US, businesses, consumers, etc. All he's trying to do, what I think, is bring people to the table for negotiation and negotiate a better deal, especially when it comes to goods and services with China and the US. Now, let's say he does impose these tariffs. What people do not understand is that you can you do have currency debasement. So if you are China and Trump has just put a 25% tariff on your goods and services, you have another option to kind of do. What is, you can kind of debase your currency against the US dollar, what obviously would make the dollar go up. But again, you have this dynamic, right, where they are the largest buyer, was the largest buyer of US treasuries, and they have something in their back pocket, what is the selling of US treasuries, what would then impose the cost of borrowing and the cost of capital on US consumers to be extremely expensive. So you have this massive dynamic, especially when it comes to currency debasement, as well as thank you. So you have this massive dynamic, especially when it comes to, let's say, trade tariffs. It's not as simple as we are going to impose a 25% tariff on China, because there's so many different things what China can do, especially to get around these tariffs. I mean, they're very clever, right? I mean, this whole idea that the US is going to impose this because it's basically shooting itself in the foot. And like I said, I think it's Trump says these things to get people to the table to obviously do the negotiations. Now, the other dynamics, what I also think is very interesting to pay attention to, is what is happening in Japan. Now, we had the Japanese carry trade, what a lot of people were talking about, and this ultimately, again, executive summary is that people were borrowing money in Japanese yen, and then they were lending it out in the US, and obviously making the spread as a result. Now, Japan is in a lot of trouble, really, in terms of their debt to GDP. They are significantly in debt. Now, they are trying to raise their interest rates, but I think every man and his dog is fully aware that they cannot sustain these interest rates anytime soon, because obviously they have, let's say, long duration debt, what need to roll over onto these, let's say, high rates, high in comparison to Japan. I mean, when you're that indebted, I mean, it's just absolutely crippling. So I don't think a lot of people are really buying the whole Japan high interest rate narrative, you know. So that is one thing to kind of consider. Also, as well, something else where a lot of people, I believe, are not really paying close attention to, and that is the euro-dollar system. Ultimately, the executive summary again of the euro-dollar system is basically it's the creation of US dollars outside of the US banking system. And this, I mean, obviously it's called the euro-dollar system, but ultimately it's dollars what are not necessarily accounted for in the US. Now, this system is incredibly large, and it's very, very, very fragile, especially when it comes to long-term rates and short-term rates. So any, let's say, large fluctuations in bond prices or whatever can be very catastrophic for markets in general. I think I'm probably going to do a longer form video, especially when it comes to the euro-dollar system, because I think it's so misunderstood and it's so interesting to actually understand it. So what does all of this mean? Now, me personally, I do believe that we are going back to a hard money standard, meaning that we are going to more, let's say, gold or Bitcoin. Now, obviously, this whole debate and divide between gold and Bitcoin can be hours and hours and hours and hours long, but I just think that many investors, especially in the bond markets, I really don't believe that they are going to be happy with 4% interest rates for the next, 4% return on tying up your money for, let's say, 10 years, when you are fully aware that these governments and these central banks are going to be printing money and obviously debasing the currency. Now, obviously, when you have a, let's say, currency what has an unlimited amount of supply, and you have assets what are scarce in supply, obviously number goes up, right? Price goes up. So for me, I think it kind of all boils back down to hard assets and hard commodities. And obviously how this all plays out, I think is obviously up for debate as well, but that is just how I am currently seeing things. I just think it's very, very interesting when you look at, like I was saying, between the 1920s and today. Now, I'm not going to ramble on too much, but that is just how I'm thinking about things. Hopefully you found this video informative. And if you want me to kind of go over any of the points what I was talking about, obviously about the euro-dollar system, about obviously what is going on in Japan, obviously the gold standard or Bitcoin standard, how kind of all of that plays out. I mean, I've really thought about these different types of scenarios for a number of weeks and months, to be honest, and obviously listened to a lot of debates, but I really do think that all roads lead to Bitcoin. Really, it kind of makes a lot more sense. Obviously, saying that is very polarizing, but anyway, to the 4 people who watch me, I hope you're having a lovely day wherever you are. And yeah, really appreciate the support. Obviously, like, comment, and subscribe. And I'll see you in the next video. Take care. Bye-bye.